Today, we're diving into something that's becoming a massive deal for anyone in global business. The really fascinating and honestly pretty confusing split in digital currency rules between mainland China and Hong Kong.
So let's just get right to it. It's a real head-scratcher, right? One country, one flag, but two completely different playbooks for digital money. Over in the mainland, they've built a fortress, but in Hong Kong, they've opened a gate. If you're investing in or trading with China, you absolutely have to understand why this is happening.
Okay, so before we can unpack the why behind the split, we've got to get on the same page about the what. We're really talking about two totally different kinds of digital money here, and they're at the heart of this whole story.
First up, you've got your central bank digital currency, or CBDC. The easiest way to think about this is that it's just like the cash in your wallet, but digital. It's the official stuff, issued straight from the central bank, like the digital Yuan. It's got the full backing and legal power of the government behind it. It's the real deal.
Now, on the other side of the ring, we have stablecoins. These are a whole different animal. They're not made by governments, they're created by private companies. And their whole promise that one token is worth $1, for example, depends entirely on whether that company actually has the real money stashed away in reserves to back it up.
So here's the bottom line, the thing you have to remember. A CBDC is public government money. A stablecoin, that's a private token. It's kind of like a digital IOU, a promise from a company that you can trade it in for real money. And that one difference, well, it explains everything.
All right, let's look at how this all works in mainland China. You can really picture it as a financial fortress. They're building this one single official highway for digital money, and they're shutting down every other private side road. And they're not messing around. Since 2021, they've rolled out a total ban on private crypto. They flat out said stablecoins are virtual currencies, which makes doing anything with them, making them, trading them, even just helping someone else trade them, completely illegal. The message couldn't be clear. It's the digital yuan or nothing. So you have to ask, why build this fortress? What's the big idea?
Well, it really boils down to three huge goals. Number one, they want to protect their own currency. They absolutely do not want a shadow economy based on US dollar stablecoins popping up. Two, they want to lock down financial security, shutting the door on money leaving the country illegally. And three, they want to pour all of their energy and innovation into their one state-run project, the digital yuan.
Okay, so that's the fortress. Now let's hop over to Hong Kong, which is playing a totally different game. It's not a fortress at all. It's China's regulated, international gateway to digital finance. It's the global bridge.
And this didn't just happen overnight. Nope. This has been a very careful, step-by-step process. It kicked off back in 2022 when the authorities in Hong Kong started dropping hints. That led to a ton of discussion, and finally, the Stablecoin Ordinance was passed. It's all set to go live on August 1st, 2025, creating one of the first and most robust licensing systems in the entire world. But, and this is a huge but, don't mistake open for the Wild West. Far from it. To set up shop in Hong Kong, you need a license. You need to prove you have 100% reserves in top quality assets. You have to keep customer money totally separate, and you've got to open your books for regular audits. This is all about building trust.
So let's just put this all together side by side. It's pretty stark. The mainland, total prohibition. Hong Kong, strict regulation. The mainland is all in on the digital yuan. Hong Kong is looking at its own digital e-HKD plus licensed stablecoins. So what does this actually mean for your business? In the mainland, you stick to the official renminbi channels, period. But Hong Kong, that's your regulated on-ramp to the entire world of digital assets and Web3.
All right, so now we get to the most important part. The so what? You've got all this info, but how do you actually operate? Let's turn this into a super clear, actionable playbook for you.
It really comes down to a three-step strategy. Step one, in mainland China, you stay on the official highway. That means using your normal renminbi bank accounts, but also keeping a really close eye on the digital yuan pilots for cross-border payments. Step two, you use Hong Kong as your strategic bridge. It's the perfect intermediate layer where you can use regulated stablecoins for asset management or for your Web3 projects. And step three is to just internalize this dual setup. The two strategies aren't fighting each other. They're designed to work together. If you remember just one thing, let it be this. Mainland China is all about security and control. Hong Kong is all about openness and connection. One part protects the core of the system, while the other connects it to the rest of the world. It's two parts of a single, very deliberate strategy.
And make no mistake, this isn't just a regional story. This has huge global implications.
Even the World Economic Forum is pointing out that a regulated hub for stablecoins in Asia, with Hong Kong right at the center, could seriously start to challenge the US dollar's dominance in global finance.
Which leaves us with a really big question to think about. Are we watching, in real time, the construction of a whole new digital financial order in Asia? And is China's two-part strategy the very foundation of it? How this plays out is going to define the world of money for a long, long time.